Hi, my name's David Bell. I'm the author of the Macro AUDJPY newsletter, and today I just want to speak with you about the Aussie yen and the effect that the Japanese and Australian data had on it overnight. So at 12:30 GMT, we had the Japanese PMI, manufacturing PMI, come out, and the Aussie employment change. The Japanese PMI came out at 48.5 with a previous of 50.3, so that's pretty contractionary. And the Aussie employment change was 31.9 thousand with an expected of 15,000. So they added 16.9k jobs over January, which is a fairly big beat in all fairness. So how does that relate then to the Aussie yen? So we saw the Aussie yen make an initial rally up into 79.82. And I've actually been saying to Macro AUDJPY newsletter subscribers to sell any rally into the 80 handle. I just see that because Aussie yen is such a risk proxy where, you sell the Aussie because it's commodity backed when risk is off, and you tend to buy yen in the same risk off environment. So it just seems like a relatively obvious trade with all of this deteriorating data, slowing data, and general sentiment about the global economy. So we actually saw it rally up into, as I said, 79.82. It's currently trading at 78.68. And for me, I actually see a lot more downside going into this. I actually wrote an article a few years ago saying that the Aussie yen can actually signal recession. Now, one of the things that's actually leading me to believe that we're in a pretty dangerous time is that the Aussie 10-year yield is actually yielding less than the Fed funds rate. Now, the last time this happened was actually with the dot-com bubble, and the time before that was just before the Asian crisis kicked off. So we're kind of seeing two repeating patterns here where asset prices are really, really overvalued, but also there is the possibility of contagion. If you recognize that the USD denominated debt, excluding China in Asia, is $2.1 trillion, you've got a rallying dollar at the moment. Is there really the possibility that some Asian countries could default on their debt? And that could cause massive contagion again, like we had in 97, 98, and leading into the dot-com bubble. So that's kind of my thesis going forward. And I believe that there's currently a support level at about 77, just above 77. And I think if we break that, there is not any real reason as to why we can't get down to 70 going forward, because I truly see that there is a massive deterioration coming in global economic data, and especially with industrial production being kind of in the doldrums, and also seemingly that US manufacturing data is likely to follow. I think looking at a risk proxy pair such as Aussie yen is a good bet to get in quite cheaply onto any downside risk.